And we're
All
on.
right. All right, Neil, what up?
How you doing?
Good. Thanks for joining me. This is kind of my idea to switch up the format of the podcast or the screen recording. Been at Regency Capital now for a little bit more than a year. 2023 was my first full year. It's been a great experience and something I've really enjoyed and look forward to continuing to build with you and the rest of the team. We've been doing a lot of content and putting out some of our investment ideas and philosophies out there for the clients and for various people to read and understand. And I thought that it would be a great idea to follow up on some of the videos that you've already created. I'm now quite a bit client facing, so I get quite a bit of questions, whether it's from some of your clients or some of my new clients or various people in the community. And so I thought I would pass some of those along to you in this version of the podcast, to help them learn a little bit more about what we're seeing in the markets and to help myself learn as well. So I'm looking forward to this.
I appreciate that, and thanks for this sort of ad hoc conversation. And this is really ad hoc. We didn't plan beforehand. Don't really have much of an agenda, but no, I get the topic, and it is timely, especially like days like today. Really nice up after a week of mostly down, and I don't think I'll sort of let you lead with questions. I don't think anything has changed particularly much since any communications over the last 6 months or so. Equities are uh, equities are complex, always are, but especially now because you have to talk about when you talk about stocks, for instance, or equities. What do you mean exactly? Do you mean the S&P 500? Do you mean the average stock? Do you mean the biggest of the big U.S. corporations? That's sort of become a thing in and of itself, and we talked about bifurcated markets and whether big versus small, growth versus value, U.S. versus international. There's sector versus sector. It's been really interesting, and probably the second in my career where I've seen these kinds of bifurcations. The good news is that some stuff out there is just plainly obvious, especially when it comes to uh, trying to not do something stupid or to stay out of danger. But also some real gems pop up in terms of uh, general investment ideas or even very specific ones. So I would argue this is a great time to be an investor, especially an active one, or anyone who tries to just think and be methodical, and treat investments like any other asset business. At the end of the day, you're giving money and you're receiving some kind of thing of value in return. And the trick is to pay less than what you get.
Sure. Can you I guess dive into that a little bit deeper? I mean, I think there's always this discussion between active and passive management. Why, in this particular period, do you feel so strongly about kind of the way that we go about doing things?
Good question. So yeah, passive comes up a lot. When people mean passive, what they mean is passive on uh, the equity selection side. Passive meaning you're following what the market does as a whole. So the market assigns various values. It assigns Apple and Microsoft at $3 trillion a piece, and it assigns a value to other businesses that are much smaller, 1 billion, 10 billion, 100 billion, take your pick. Um, so when people say passive, what they mean is just do the S&P 500 or some similar benchmark. Passive does not mean less risk, right? So I hear this a lot, and I think at some point in time, investors will learn this lesson. Passive does not mean passive. When you're a passive investor, quote unquote, yeah, you're leaving it up to the market to decide what stocks you hold and how much, for any given allocation into that. but you are assuming 100% market risk. So stock market as a whole fluctuates. There's a lot of things in there that will appreciate in value over time. Very few of them actually will appreciate indefinitely. A lot of them will go out of business at some point in time. A lot of them will be duds, if not most. But in the short and medium term, you are very much, at the whims of the market. So fear and greed, you're taking on market risk. Now, as long as corporate America continues to earn more money, and assuming there's rule of law and the laws and the rules and even the culture is fiduciary and investor minded, then inevitably the value of what the market assigns as the value of those stocks should go up over time as a whole. But yeah, passive does not mean less risk. Passive means, again, letting the market divvy up how much you have in from Apple all the way down to something really small. This time is very reminiscent of the 90s in the sense that you have so much value at the very top. So, the top seven, or they call it Magnificent Seven, or the top 10 companies in the United States are quite large, about a third of the market. And for some time, they have been, even though a third of the market, which is kind of big, if you think about 500 stocks in the S&P and 7 to 10 or a third of it, they've been, even though they're a third, they've been contributing way above their weighting in terms of market returns. And this has been going on almost every year since, the great financial crisis. This past year was like that too. 2022, the big fell a lot because they were up a lot over many years. This year was a really sharp rebound. And for most of the year, virtually all of the returns of the market, or at least the American stock market, were driven by, 7 companies. Toward the end, it broadened out a little bit. Other stocks and sizes did participate, but in 2023, these 7 stocks were still about half of the returns for the stock market, and stock market had a great year, 20, 22, 23%, depending on your index, but half of that was 7 stocks. And to put a finer point on it, we'd say that 7 to 10 is about a third of the market. You're talking about Apple and Microsoft specifically having, what is it, 5-6% of the market is just one company, right? So now we've come to a place where even 2 of these companies are bigger than entire market caps of some very large countries.
Yeah, no, that's interesting. I think, the Magnificent Seven, the tech industry, AI is obviously kind of taken over headlines. Been a hot news topic. I know we've addressed that a little bit, and I'm being cautious. I mean, I think we've released some some of our thoughts on that. I guess a continuation question could be, okay, maybe we're a little bit cautious of the market in general, or the large cap tech stuff. How does an active manager get some performance elsewhere? What are some of the things that you're really excited about? Where are you finding value moving forward long term for our clients?
Good question. And, and the sort of glib answer is that, if you don't have a lot of these biggest of the big in size, it's really hard to outperform the market, right? Because managers inevitably diversify, maybe unwilling to hold a third in 7 stocks. Or the number I like to use is, I think if you combine tech and what they call the communication sector, which is Google and Netflix and your internet-based companies, and put in Amazon, which I think is tech. It's sort of communications internet. It's classified as a consumer discretionary stock,
Sure.
not unlike Nike or something like that. But anyway, you take these sort of big tech companies, tech and big tech internet types, you put them together. I think it's well over 40% of the market. So even though it's a big country. It's a big corporate America. Uh, think about this, 40% plus of the value of all this stuff is quite intangible, which is probably, in a way, it's sort of a triumph of capitalism, and really, really speaks to the longer term hope of, humans, making things out of nothing, right? Productivity, ingenuity, technology. Um, but yeah, it's hard. I was telling you earlier, I was kind of surprised where the numbers for us uh, fell into in 2023, because you looked at it. If you looked at it, you would think we had a whole bunch of this stuff, and so and we have it. I mean, to say underweight technology and internet would be sort of understating it. We were really under, um, and yet we did just fine. I think a lot of that's luck. A lot of that is some individual stocks really doing pretty well. I think part of it is just not having something that really really blew up, um, or chunk of the portfolio not blowing up. But yeah, certainly luck has something to do with it. But I would have expected a lot. I would have expected underperformance this year, instead of what we got.
Yeah, I think when we kind of recapped the 2023 numbers, I think that was something that I learned a lot about and was obviously pleasantly surprised that, for the most part, we did really well and kept up with a lot of those indices, despite not having some of those large companies. And, for you, I guess, not taking some of that risk, and the volatility numbers were down as well. How do you, as a manager, think about some of those different ratios and the volatility numbers, risk reward? Because, for me, when I look at some of that stuff, and I know as from an institutional perspective, they want to see the risk and the volatility down, obviously returns up. And I think that's, we did that pretty well in 2023.
Yeah, and I guess we have to give some context about what we're talking about in terms of strategy, right? Most clients, most money that we run is a form of a multi-asset portfolio, meaning it's either balanced uh, or what we call all-weather absolute return, which is a very multi-risk aware portfolio. This is money that we really want to curb the downside. This is not equity money, which I'd argue to have an all stock portfolio, and we do. We have a good amount of money under management that's in all stock. Um, but that portfolio, you have to be prepared for it being down 50% in a year, maybe more. It's happened. It's happened a handful of times, and this past century, and uh, nothing nothing would suggest that whether it's the Fed or fiscal policy, that they can really smooth out that volatility. Crowds are going to do what crowds are going to do. They're going to get greedy, and they're going to get very fearful. You have to be very comfortable, especially for quote passive, where they're 100% in stocks and following Jack Bogle's advice. And again, nothing wrong with that advice. Nothing wrong with just holding an index. The hard part is sticking to it. So you have to, your long-term bets have to, or long-term assumption has to pay off that, things will continue to go up, and you have to have the sort of the fortitude or discipline to stand when things get rough. That's not most of our clients. That's not me, frankly. I volatility, I welcome it prospectively, but at the same time, I don't necessarily want to be 100% equity if looking at everything in total, right? So and nobody has money with us that's all they've got, and it's all kind of riding on stocks. But most of our clients are multi-asset. They care more about the downside. They've made it, so to speak. Big margin of safety, a lot of savings and investment versus what they're going to need to live on for the rest of their lives. And so the downside protection is pretty key, because uh, even though things should continue to go up, and the Warren Buffetts of the world are right that just give it 7 to 10 years and you'll surely be at least even in the market, even if it's a bad environment. That's still that's still an assumption. And, I, for one, don't think one should hinge their retirement on that advice that, don't worry, in 10 years or more, or in the long term, things can only go up. Most experiences around the world and over time show that's not true. Virtually no place has the American experience when it comes to asset prices over the last 100 years. Um, so anyway, multi-risk aware, uh, curb the downside, both by sort of a conservative approach or first trying to figure out how to stay out of trouble. Having multi-assets and things like cash, which, by the way, now pays about 5.4% annually when you do it in T-bills like we do. That does sort of cushion the inevitable volatility of equity and present some opportunities to buy some more at prices you feel good about. And I keep harping on value and prices because it's also a way, besides getting quality and getting a good deal, it does make, because those will quality and value will fluctuate too. They will be volatile, but I know I, for one, have a much easier time holding and staying in the game and compounding money when I know and understand the businesses behind the stocks,
Sure.
rather than this sort of, intangible, ephemeral thing called the market.
Yep. I think that's a great nuanced discussion just about surrounding this idea that, markets will always kind of come back or go up. I think that's interesting for a lot of clients and people out there because you hear that kind of sentiment a lot, but there's a lot that goes into some of those deep beliefs. And, I think those are valuable points to consider when, taking on some of those, I guess, assumptions. Let's kind of piggyback on that thought what you're just talking about here about value. I think, one of the main questions that I've gotten is, after your last video, you mentioned kind of taking some of the chips off the table as we're, in this kind of, I guess, unprecedented market, Magnificent Seven, etc. What does taking chips off the table mean? Can you go into that a little bit more when it comes to clients in portfolios with some fixed income, like
Right.
you're talking about, and then also for clients that are in an all equity strategy? Talk to me
Right.
a little bit about that and
Yeah. So
clarify that for some people.
yeah. So taking chips off the table. Right. And you're right. You have to sort of define it according to what some context, right? And so for conservative portfolios, let's say taking chips off the table does literally mean paring back, equity exposure or things that have had a really great run. You're not in love with the prices. You're definitely not in love with the sentiment, and especially at the S&P 500 and the biggest of the big. So you literally take some chips off the table. Now, expensive stocks, or at least market cap weighted stocks, uh, that's one factor. The other factor is you have to always look at opportunity cost, right? Opportunity cost means the highest, best use of your money anywhere else, including cash, right? So one nice thing about higher interest rates is not only do we earn more on cash and lending in general, because interest rates, treasury interest rates are a big function of what investment grade corporates are, or muni bonds, things like that. Interest rates go up means it's harder for borrowers, better for lenders. So that's nice, of course, as a lender, and our clients represent lenders because we're investing excess capital. But the other thing too is with higher rates, the bar the bar gets higher and higher, so to speak, for stocks that justify themselves. So if I can book 5.5% in cash, am I necessarily willing to pay 25, 30 times earnings for stocks as a whole? Less so than if interest rates are 1% or zero, right? We were just got through a period where interest rates were zero, and anything with a pulse, whether it was income or flashes of growth, commanded a huge multiple. Interest rates have gone up. The multiples come down in spots, but it also has stayed pretty high overall. And I think, and part of the thesis and assumption here is, or at least the hypothesis here is that markets are justifying these really high prices, high multiples, high PEs, because it expects interest rates to come down and collapse imminently. And I look at things in terms of what's the price of being wrong. If the market's wrong on that interest rate falling thing, then I think stocks might have some huge headwinds.
Sure.
If we're wrong in terms of worrying about that and being a little extra conservative, what's our price of being wrong? Well, we've got more things compounding at closer to 5.5% than possibly 15%, even though we'll have some doing that as well.
Right.
So and that's what clients
That makes
almost
sense.
always hire us for. If you're talking about stocks, what
Yeah,
is taking chips
take
off
me
the
through that.
table?
Yeah, exactly. Let's get into
Right.
the all
So
equity
yeah,
portfolio.
it's sort of a continuation of what's already been happening now for a couple of years, taking money out of technology, number one, and into some areas of the market where there is a lot more value, and uh, value in terms of present value of all free cash flow that any company is going to produce. Uh, and it does mean having a cash cushion. So our average stocks now, stock portfolios, if they're run to model and we're not hanging on to extra stuff because of mandates to cap the tax bill, they have about 10 to 12% cash, which I'd argue is not a lot. It's still, you're still almost 9/10 fully invested. So when I say taking chips off the table for an equity strategy, it's not taking all your marbles and going home. It's pare back. And you have to remember the equity mindset, risk and return is defined differently. Risk and return is, the context is time. Volatility is not necessarily a bad thing. Like I said, you have to expect it. You have to be okay with it. And, I think these portfolios are, because they represent a small percentage of clients' net worth.
Right. I was
And
just going to say
yeah,
that, in some cases, it's kind of a nice hedge or balance, because a lot of times clients will have, various equity positions outside of the firm on their
right,
own. And they might be in certain, heavier percentage
right,
tax in other areas. And so I think, and that's quite frankly, that's why they hire us, especially to protect on that downside. Okay, so maybe a little bit heavier cash, maybe a little bit heavier fixed income for some of the more conservative portfolios. For the equity side, what are we excited about? This is kind of the final question of this one. What are we excited about moving forward? What sectors? Maybe give a couple of companies that you love, where we're finding value that we can compete, hopefully on the performance, outside of those top 7 to 10 stocks.
right. So, I keep talking about bifurcated markets, and take small versus large. So we're hunting and buying and holding more things that have a smaller market cap than a larger one. And nowadays you have to remember, small cap is still, uh, by most definitions, it's a $10 billion valued company. That's pretty large, right? I mean, in Hawaii, we don't have a single company that's worth $10 billion.
Yeah.
Not even half that. So these are still large corporations, but what I'm finding are companies that are virtually the same as a big one, uh, especially in terms of their margins and cash flow and even growth. Uh, and you're just paying a lot. You're paying a lot lower multiple for it, to upwards of half of the multiple. So, and it's kind of across sectors. So you can have a big industrial, um, uh, you know, everyone knows, like, the electrification thing is happening, right? So a lot of money is being spent on everything from server farms to substations to uninterrupted power, uh, controls and this and that. There are a lot of companies in that game, but you see the largest ones are trading 30 times forward earnings, and you have a small one where they may not sell everything that goes into this electric infrastructure, but they're still great products. They're necessary products. They're products that have virtually the same margin or sometimes better. And they're trading for not 30, 35 times, they're trading for 15 or less.
20, yeah.
The bifurcations within industry, it's in sectors across the board. Not so much in tech. I'd argue maybe some in tech, but take real estate, for instance. And I've long had a bias against real estate securities, i.e. real estate investment trusts or REITs. But commercial real estate, I can't think of an area I want to invest in least than commercial real estate at this point. But you're seeing these stocks all fall in unison when some of them are not as risky or more valuable or not levered to the hilt. So, we're finding companies in there that have really good yields, i.e. 5% plus on average, lowest multiples they've been in a long time, much cheaper real estate than if you went out and bought on your own, which I'd always argue with people that you like it real estate, do it outside of securities. REIT managers are not real fiduciaries, and there's a lot of expenses and overhead that you end up paying for. And, you're much better doing real estate on your own or through some kind of fund or hui that is, just doing a pass-through investment portfolio. That's different today. Today, the publicly traded stuff, all things equal, is much more expensive than the private market stuff. And I don't, even at these prices, am I crazy about these things? No. Why do we have 3, 4 of them now? Small positions. The downside seems pretty low, and that's how I know I tend to go about stocks in general, is just, instead of looking at the upside and forecasting what it can grow to and having price targets, I look at it and say, what's the chances that 3 to 5 years later, this thing will be down substantially?
I love that perspective because I think we can all get caught up, and me included, in reading the news, a lot of price target headlines, etc. And so just listening to kind of the thought process that goes behind our portfolios, asymmetric bets, kind of talking about downside, upside as well. I mean, I think that's super valuable for people, and we tend to forget a lot of that stuff. So I
Yeah,
appreciate that perspective.
right. And real estate's a wide landscape. You have everything from server farms to strip malls to old, big malls, office buildings, hospitals, apartment buildings. I mean, they're all kinds of REITs. So what areas of real estate that we're in? It's really just two kinds. One is in our backyard. So we've been accumulating Alexander Baldwin. At first reluctantly, I had no desire to own a local company, even all things equal. But there have been some changes. There's a lot of square footage you own, a lot of prime, irreplaceable properties that you have, selling at prices that are lower than what you'd see on, some of these properties sold on the open market.
Sure.
So replacement value. And am I terribly bullish about the future of Hawaii or Hawaiian real estate? No, but this one just seems really oddly priced, given all the good changes that have happened, and you're getting paid a ton while you wait. But most of the real estate holdings, it's basically Sunbelt and Southeast apartment buildings. So no office buildings, no strip malls, none of that stuff. We basically have apartments, and you look at these apartments on a per unit, per key basis, like what you're actually paying. You look at the growth in rents, and some of these places have untapped pricing power because, as some of these rents are coming due, and then they'll be higher in monthly rent. It's also, for the first time in a long time, it's cheaper to rent than to buy. When mortgage rates are 7%, renting all of a sudden becomes a lot more attractive. You have more pricing power too as a landlord, but also just being in the areas that need more housing. So again, the Southeast, the Sunbelt, the places that people are coming to, migrating to from north and south, but these are, these just look like good deals by themselves. So they're kind of made regardless of the stock market. It's really more academic. We pay X, we get Y, and the downside seems um, pretty manageable to small.
Yeah. This is part of the love that I have of the new job is this type of learning where we're looking at a company in our own backyard. We've analyzed that quite a bit together. Know some people within the company. That's a great exercise. And then we're looking at companies and learning about them in the Southeast,
Right.
which is pretty wild and fun. One last question, one that we've kind of been in a little bit, one that I've enjoyed talking story with you about and learning some of your theses on is Invista, which is a dental supply company.
Right.
Talk us through some of your thought process on that, real quick. Got about a minute. Why you like that one potentially, and yeah, just moving to the future with cosmetic dentistry.
Well, to talk about Invista, you have to talk about Danaher. So that's a key core holding for us.
One of your favorites.
Danaher is a combination of a great investment company with the operational prowess of a Toyota. They buy good companies pretty cheaply and they make them better. However, Danaher got so big it started spinning off some things, and so we bought a couple of our spinoffs. The last one was this Invista, which is another one of these 800-pound gorillas in a niche. The dental market's not big. 2, 3 companies really have the market. These guys are number 2, and it's just a beaten up stock. And the market as a whole hasn't grown much lately, a lot because of COVID. But it's a cheap stock, and they have really mission critical, necessary things, demographic tailwinds, cosmetic tailwinds,
Social
technological
media
tailwinds,
tailwinds.
social media tailwinds. They are downstream from a lot of innovation that's happened in all things healthcare and dentistry, and it just seems like a good annuity type business. I think the growth rate, if it comes back, and there's expectations are pretty low, this thing could go up a lot. But as a spinoffs are always a good place to shop too, because nobody really holds them, and when they get the spinoff, they just sell them. But I like sometimes you have these quality spinoffs that are spun off really because the main company, Danaher, is just too big and needs to simplify, and little industries like dentistry is now sort of too small. Danaher really is about big life sciences stuff. It's like a Thermo Fisher, and the machines that are needed to do science and make drugs, um, and all kinds of tests and measurement equipment, all that stuff. Like that's really big for them. Little things like dentistry, um, and other things like the pumps at the gas station are only 2 companies really do that. Or we talked about Pantone Colors, right? It's a royalty company. They had that too. Now it's part of Veralto, which we have. So anyway, just kind of a one-off thing, but
Yeah,
doesn't correlate to the market. It's not very cyclical. One would hope, or continues not to be cyclical. And again, just a tiny part. That one's probably one of the smallest holdings, if not the
sure,
smallest. But
sure.
sometimes you need a toehold in. You learn even more about it, and revise the thesis. And a lot of times the money's really made on the second or third tranche.
Yeah, we'll see kind of how that plays out, but I love the discussion because again, it goes into the thought processes behind it, tailwinds, spin-offs, all those things are really interesting that um, a lot of people don't necessarily talk about. And I'm gonna cut you off there because we've gone a little bit over time, but and I know you could keep going on and on because you eat, sleep, love all of this stuff, and it's awesome. But we'll join again and have another topic soon. Thanks, Neil.
Thank you.